cashier under the money professional, and it's called the Good Money Book. So we're going to get right into it. So operating expenses. First, for you, before we even get started and start telling you what type are they, how to control them, we need to make sure that you even know what they are, right? There is a lot of confusion with business owners. It's even seasoned business owners as well as new business owners. What exactly are operating expenses? So I'm going to give you the official definition, and then I'm going to give you my definition. So the official definition for operating expenses are expenses paid regarding a business operations. So as you can see, that definition is very vague, which is why a lot of people was like, I thought that was the operating expense. Why isn't it type of thing, right? So another characteristic of operating expenses are they are key activities that help you generate income. And then they're also often referred to as OPEX. So if you are doing like a grant or you're looking for investors and they may use the term, well, what is your OPEX? Now you know what they're talking about. They're talking about operating expenses. So my definition that's kind of is going to help you understand it a little more clear. Operating expenses, they are not tied to a customer. They're not tied to a client. They're tied to your business. So for instance, with my accounting firm, I have Zoom because I do free webinars, right? That is an operating expense because that's not, I can't say this particular client needs Zoom. All of my clients need Zoom, or all of my leads or prospects uses Zoom. So with operating expense, that's one of the key features. You cannot tie operating expense to a particular client, customer, or project. It's more of a overarching cost that you need to run your business. So you need it to run your business better, but it's not tied to a client, okay, or a project. That is what makes an expense an operating expense. As we kind of get more into the different types of operating expenses, I will explain that a little more, and that should hopefully make sense to you. So the importance of operating expense, I wanted to put this first so you can go ahead and say, okay, why do I need to pay attention? That is pretty much what this is going to say. Why do I need to listen to her? Why do I need to pay attention? Why? What does this have to do with my business? So that is what the importance of operating expenses is going to explain to you. So the first thing first, operating expenses are used to calculate other ratios in your business. So that's why I use the example, if you're doing a grant or if you're looking for investors, they may say, what's your OPEX? Almost everything in your business is going to come off of operating expenses, almost every calculation, right? If you want to do profit margin, if you want to do what's my net income, if you're trying to look at cash flow, if you're doing a break-even analysis, which is something that every business owner should do at least quarterly, but we'll get into that later. But operating expenses are used to calculate a plethora of other different business ratios. So the importance of why you need to not only know what they are and how to calculate them is because if you get your operating expenses calculation wrong, everything else is wrong. So this is kind of where the snowball can get bigger and bigger and bigger and just cause havoc in your business. So you want to make sure that at this part in your business, you know what your operating expenses are, okay? Again, operating expenses can eat up your profits or your cash. So not profits and cash, because profits and cash are different, but they can eat up your profits and your cash, right? If you have too many operating expenses, more than likely you're going to have a low gross profit. If you have a lot of, if you have too many operating expenses, you're going to have less cash because you're also constantly paying out these things. For instance, my Zoom subscription, I think is like $13, $14 a month. I did the annual plan, so I can't even really remember how much I paid for it, but that was cash that had to go out of my business, right? But if you go back to the definition of operating expenses, it says that these are expenses are used to generate revenue. And it's true. I use Zoom to get more clients, to get my brand out there, because I'm not originally from Ohio, so a lot of people may not even know that I exist, right? So I do free webinars to teach people the basics of bookkeeping or the basics of taxes, or to just have little chit chats, but I had to pay for that expense. But once most people come to one or two of my webinars, they normally reach out for either a consultation, tax prep, something. So it's helping me to generate revenue. But in order to generate that revenue, I had to first buy the subscription. So this is where it comes in. It takes money to make money. I had to spend the money out before I was able to get more money through the door by having more prospects come through, right? So it can eat up your cash. Also, when you look at your operating expenses, and even if you do like a break-even analysis, or if you just do what are my operating expenses and let me add that up, it will help you identify waste. And the reason why I say this, I do a break-even analysis with all of my monthly bookkeeping clients. We do it at least once a quarter. When we go through the numbers, they're like, I didn't even know I was still paying for that. Or I thought I canceled that. They're still charging me for that. Or I didn't know that was that high. Maybe I need to go lower. So operating expenses, doing the analysis around it, using the formulas to calculate even the operating expenses or the operating expense ratio, it will help you when you have leakages in your business. So that's another reason why it is so important to make sure you keep an eye on these type of expenses. So now we're getting into the nitty gritty, the different type of OPEX. So again, OPEX is operating expenses. So let's go to the first one. The first one is the easiest, and it's the easiest to explain and to understand, in my opinion. So first you have fixed expenses. So when you think of fixed expenses for your business, these are expenses that do not change month to month. When you're thinking of creating a budget for your business, these are normally the expenses that you will put in your budget. Right? So for instance, my cell phone bill, I have rent for my office space, right? Those are fixed expenses. They're not going to change month over month over month. Another really great example of a fixed expense are your paying your bookkeeper or your accountant. For most bookkeepers or accountants, they don't bill you based on how much work they do for you or how many hours, right? That's more of a consulting type of pricing model. Most bookkeepers say, hey, it's going to be this amount a month. That will be a fixed expense for your business. Okay, so fixed expenses do not change month over month. Periodic expenses are those things that are seasonal. Think of periodic expenses as seasonal expenses. So if we go outside of business for personal, or we could even use this for the business. Say you have a business car. You don't have an oil change every month. You may have it every 3 months. It depends on your mileage. It may be every 4 or 5 months, right? Like for instance, with my car, it's every 4 to 5 months. And that's because I have to use this synthetic type of oil. I don't know what it is, y'all. I just know I go by the sticker that they put on my car, and it normally is around every 4 months. That is a periodic expense for my business because it's my business car. Another periodic expenses for your business may be taxes. Like most people, if you're doing federal taxes, right, that's not a monthly expense. You may save for it monthly, but you don't pay it monthly, right? So most people pay estimated taxes every quarter. So 15 days after the quarter ends. So the one that just passed was April 15th. Your first quarter estimated payments were due on April 15th. That is a periodic expense. Another variable expense. So variable expenses, these are the most difficult to understand, the most difficult to track, and these expenses have the greater probability of making you bankrupt. And the reason why is because they're, like I just said, they're so hard to track. Well, they're not hard, but they're more difficult than the other two to track. So variable expenses, these are the expenses that change constantly. You cannot say, that's when people say it's around this much a month, because you don't have a hard number. Like this month is this, the next month it could be this. So for instance, a variable expenses for personal would be like your electricity bill. Even though you have to pay that monthly, so some people would say, hey, that's a fixed expense. No, you have to pay it monthly, but it changes every single month. Another way to understand variable expenses is they change based on volume, or based on production, or based on the number of clients you have, right? So if we go to a retail industry, a retail business, a variable expense for retail businesses is shipping. Shipping changes every single month. I've never had shipping where it was the exact same number every single month. even if you had the exact sales, right? You maybe made 15,000 this month and you made 15,000 this month, but your shipping would still be drastically different, or it may titter-totter a little bit. For consulting or for service-based businesses, anything that you have to provide to your client one for one, that is a variable expense. For instance, if I have a bookkeeping client, I cannot, when I buy a QuickBooks subscription for a bookkeeping client, I can't use that one bookkeeping subscription over 10 clients. That one bookkeeping subscription is for one client. So if I get more clients, I'm going to have more QuickBooks subscription fees, right? So that's what I mean by variable expenses are based on production, based on volume, based on the number of clients. Unlike fixed expenses, variable expenses can be tied to a client, and it should be tied to a client or to an activity, for instance, right? So again, with retail, if you have a shipping expense, you will be able to tie that to the order, right? If you don't necessarily do it in your QuickBooks, you would definitely do it in your Shopify, or if you do, you use Comment Sold or whatever you use to process your orders. Every expense for shipping, you can tie it back to an order number or to an order name. Again, with service-based, you can tie it back to a client, whether you're a graphic designer, right? You may design a website for a client. And then so you may have to go to WordPress and buy a theme. When you get charged for that theme, you can tie that particular theme charge back to the client or back to the project that you brought it for. So, and this is why variable expenses are difficult to track, because if you don't have your bookkeeping in your back office, I like to call it, set up correctly, you have no way to track this stuff. You just see the cost and you're like, I don't know why it's that much. And that is something that you never want to do in business. And this is why these expenses, if they get out of control, can bankrupt a business. For instance, going back to retail, I'm harping on the retail industry today. Going back to retail, if you just don't know why you're paying all of what you're charging for shipping, right? Or what you're paying for shipping, how do you know how much to charge for shipping? That's the one thing about retail. When you have retail shipping, it's an expense, of course, but you should have shipping income and then shipping expenses. Meaning, if I ship out a shirt, it may cost me $3.50 to ship the shirt at USPS. I probably charge you for the order $5 to ship that shirt. So I technically did not pay for the shipping, you did. And then you pay me $1.50 for my time to go to the post office and actually ship it, right? So, but if I'm just constantly shipping and I'm just shipping and I'm just shipping, and I never tie it back to orders, and I never figure out, well, how much am I really spending? And I'm just waiting until the end of the month for my bookkeeper or my accountant to tell me this is how much you spent, you cannot control your shipping. Granted, with that example, if someone bought it, you have to ship it, right? Or you have to give a refund. But if you control your cost, you can say, well, I'm going to ship it next week and not this week. Those type of decisions can actually help you keep your business in order. It can help you control that cash we were talking about, right? Also, knowing how much you spend on shipping, going back to profits, you'll now know how much am I making on each shirt that I have to mail out, or each shirt that is picked up. Am I making a profit? If you don't know these expenses, you don't know those answers. Also, if you're not controlling these expenses, you don't know those answers. Okay. I heard someone say something. Was someone just trying to mute themselves, or was there a question?
There is a question in the chat.
Okay.
And it from Naomi, she's saying, where would labor fall? It can be the highest line item if not managed.
So labor can fall. That's a good question, Naomi. Labor actually falls in labor can fall in all three. Okay. So let's say fixed expenses for labor. That would be maybe your assistant. You pay her the same amount every single month. It doesn't matter, or anyone who's on salary, right? It doesn't matter how many hours they work. They're going to get this set amount of money every single month. That would be a fixed expense. You may have an intern who you just hire for 3 months. That would be a periodic expense because you're not keeping them on full time. You're just going to have these 3 months of expenses to pay them, right? It can also be a variable expense if they are hourly. So this goes back to if you're in a retail and you have a storefront and you have folks to come in to man the store. And if they are hourly paid, that's a variable expense. Again, you can tie that expense back to a person. If you say my payroll was $900 this month, and if all your employees are hourly, you should be able to break out that $900 to every single employee. And you should be able to come back to that $900 amount. So labor can fall through all three. The good way to figure out, hey, is this a fixed expense, a periodic, or a variable expense? Is it tied to production or volume? Meaning if I do more or if I expect more, do my price go up? Do my costs go up? Right? Like with salary, we could work 40 hours, 50 hours, I'm getting the same amount of money. I could work 30 hours, I'm getting the same amount of money, right? If I'm hourly, if I work 5 hours this week and then 20 hours next week, I'm getting more money next week than I will get this week. So that's based off of production, it's based off of hours, it's based off of something. It could be ounces, right? Variable expenses is really popular in the manufacturing industry. They actually have different types of accountants. They call it cost accountants that only track variable expenses. That's all they do. They don't do payroll. They don't do anything else. All they do is track variable expenses, because to a manufacturing company, that is literally what can bankrupt their business. And then I saw another question.
You do. It says, this is from Jonathan Politi. It says, if you pass along the cost of variable OPEX to clients, can you count those as OPEX?
Yes. So what you're talking about is cost of goods sold or cost of services provided. If it's a retail or a manufacturing company industry, it's going to be cost of goods sold. If it's a service provided company, it's going to be cost of services provided. So for instance, that same example for my firm, I have a new bookkeeping client. I have to then go buy a QuickBooks subscription for them. In my pricing, I don't necessarily say, hey, QuickBooks just charged me $150. Here's the invoice for $150, right? I don't do that. You can do that, but I don't do that, right? What I do is say, hey, I'm going to charge you $350 a month for bookkeeping. In that $350 is that $150 of my cost for that QuickBooks subscription. So now my profit is only $200. So that's why I said profit and cash is not the same. Each month when she pays me, she's going to pay me, or he or she's going to pay me $350. But I do not have $350 of profit. I only have $350 of cash. I now have to pay the $150 for QuickBooks. So my profit is only $200, right? So that way I'm basically recuperating my costs based off of my pricing, which is another reason why you need to know your OPEX. You need to know your expenses, because then how do you know how to price? You could actually be losing money if you're not pricing the right way. The other way, you can do what is a lot of construction companies do it this way, and is where they directly charge the client for every single thing that they own. Construction companies do that because they normally at the beginning of the project give you a big number. This is labor, this is materials, whatever. And then, you're building a house and a pipe bursts, and it's not the construction firm fault. It's just like it's a faulty pipe. The construction firm now has to go buy that pipe to replace it. They are now going to directly bill you for the cost of that pipe, and it's no markup included. It's just a one-to-one thing. So that's the two different ways that you can recuperate or get reimbursed for some of your operating expenses. But that is only for variable expenses. You cannot get, or you should not be recuperating fixed expenses, because again, fixed expenses are being spread across the entire business. You cannot tie that back to one particular client. Variable expenses you can, so you're able to just build them. Does that make sense, everybody? Okay.
Yes.
Yes.
Okay, so now we're going to go to how to calculate OPEX. So this is really fun. Says the accountant. So to calculate OPEX, what you're basically going to do, you're going to add up all of your operating expenses. So accounting supplies, office supplies, insurances, license fees, y'all see the list. It can go on and on and on. Now, one thing I do want to make mention of, and you probably heard me say it when I was explaining to Jonathan, operating expenses can also be broken out into two different categories. So you have the three different types, and then now you can begin to put those types into categories, right? So you heard me say something called COGS. COGS is literally cost of goods sold. So it's an acronym. In a service-based businesses, this is called cost of services provided. So it's COSP. What these are all still types of operating expenses, but they are a different category of operating expenses. When you have COGS, or if you have cost of services provided, you want to use those expenses to calculate your profit. COGS and cost of services provided are always going to be a variable expense, meaning you can always tie it back to a client, to production, to a project. Okay, so COGS will always be used to calculate your gross profit. There are always going to be variable expenses, and you can always tie them back to a production, a project, a client, or anything like that. Right? So in this list at the bottom, the COGS that kind of jump out to me are shipping. Shipping is a COGS, a type of COGS. Inventory or purchases is a type of COGS. Credit card processing fees. Some people think, especially now, because a lot of us are completely online, e-commerce. Credit card processing fees, some people may say, oh, that's a fixed cost because I have them every month. True, but they change every month. And they are based on what? How many orders you have, how much sales you have, right? So that will make them a COGS. That would make them a variable expense. Most people actually don't use this when they are calculating profit. And that's because if you look up any type of income statement, any type of profit margin model, they're not going to tell you to include this because back in the day, you didn't have this. Right? When these models were built, like accounting is extremely old. So credit card processing fees were not built into these models. So if you ever look it up, if you download a template, they're not going to say, oh, adding credit card processing fees. They're not going to tell you to do that. So a lot of times this is what we call, it goes below the line. And when I show you the next screen, you'll understand what I mean by below the line. But make sure when you're doing profit that you're calculating in your credit card processing fees. Why? Because then you may need to add that to your pricing model, because credit card processing fees can add up. So you may need to say, oh, if you use a credit card, I'm going to add an additional $5. I'm going to add an additional $10. If you don't track those fees, you don't know what that fee needs to be. Okay. So COGS and cost of services provided are always variable expenses, can always be tied back to a project, a client, or production. The other type of operating expenses is they normally just call it operating expenses. So you may say, what are your operating expenses? Or they may say, what are your fixed costs? Or what are your monthly expenses? Those type of terms are normally used. So that's everything else. Everything else that's not tied to your profit. So that's your accounting, that's your rent, that's your gas for your vehicle, all of that. That is going to be spread across multiple clients. It doesn't matter if I sell a product or not, I still have these fees. So those are your operating expenses that does not include COGS. So a question
we have another question.
Okay, let me go.
They want to know, where does rent fit in here?
Okay, rent is a fixed expense. Rent is fixed, so it's not used to calculate your profit. Rent doesn't change based on how many clients you have, any of that. Rent is basically the same every single month until your contract is over. They may increase it or they may decrease it, right? But so rent would be a fixed expense, and it is what we consider below the line, meaning you don't use it to calculate profit. Okay. So we're going to do a little exercise here. So this is a sample income statement. So this is what I mean when you will have revenues, cost of goods sold, gross profit, operating expenses, right? So COGS, again, COGS is used to calculate profit. COGS are always variable expenses, meaning you can tie them to a person, place, or thing. Variable expenses, COGS, are also, they change. You can't, you can estimate them, but you can't say they're going to be this amount every single month, right? They're going to basically change based off of production hours or something like that. When I say above the line and below the line, gross profit is the line. Gross profit is the line, is the imaginary line. So if someone says, well, this is an above the line expense, that means more than likely it's going to fall into cost of goods sold or cost of services provided, meaning it's going to be a variable expense. Okay, so if I say, oh, that's going to affect above the line, anything that affects above the line, it affects your profits, right? So if you are a business that is profit centric, meaning I want to grow my profits, I want to make sure my profit margin is this, you're going to be heavily focused above the line, meaning you're going to be heavily focused on cost of goods sold. Okay, below the line, again, gross profit is the imaginary line, are all of your other operating expenses. So you see how I said, if it's not COGS, they just call it operating expenses. But let's not be confused. Operating expenses and COGS are still operating expenses. So that's how it can get really muddy. So sometimes instead of them saying, what's your OPEX or what's your COGS, they'll say, what's above the line, what's below the line. Remember, gross profit is always the imaginary line, okay? So operating expenses here, those are most of your fixed expenses. So that's when you're gonna have rent, that's where you may have advertising, that's where you're gonna have your accounting fees, your lawyer fees, your graphic designer fees. All of those are probably gonna be below the line fixed expenses. Okay, so does that make sense so far? All right, so let's go through this example. We're basically going to calculate operating expenses revenue. So your operating expenses revenue, they give you a direct comparison to your expenses and your income. Of course, this is going to be like a ratio, so it's going to be less than 1. You probably don't want it more than 1. So this is one that you want to stay below 1 in. So what you're basically going to do, you're going to take all of your operating expenses. So again, operating expenses have 3 types, but they have 2 different categories. So you're going to take your COGS, which is a category of operating expenses, and you're going to add that to your other operating expenses. So in this example, above the line and below the line. So COGS is 50, operating expenses is 70. So you're going to add those 2 up, and then you're going to divide that by 200,000, which is your revenues. So this example doesn't necessarily show the differences, but they are differences in revenues. Some people think revenue is just everything that I brought into I brought in this month. That is true, but you also need to deduct discounts, given those promo codes, given those coupon codes. That is going to reduce your sales because you basically gave a discount. You also need to deduct returns. And this is how sometimes you can have negative revenues, which you don't ever want to have that, but it's sometimes possible, maybe not for the full month, but for a day. For a particular day, you may go into your Shopify and you see I have negative sales. That means you had more returns than you had sales. Okay, so to basically, you're going to take this is also called net revenue, net sales. That means I'm going to take everything I made, subtract out discounts, subtract out returns, and that's going to get me to my net sales number. So that is the number that you want to use in this equation. So you want to take your COGS plus your operating expenses, so above the line, below the line, divide that by your net revenue or your revenues. And that is going to, I keep clicking, that is going to give you a ratio, so 0.6. So what this 0.6 number tells me, or could tell you as a business owner, that 60% of your revenues are cost. This is more than likely a retail business. Retail business or manufacturing businesses have lower or higher, they have higher ratios, meaning they have more costs for each dollar of revenue, right? Sales are service-based businesses. This number is going to be lower because we're going to have more revenues for each number of costs. Because again, with a service-based business, the subscriptions will be a lot cheaper if compared to someone doing inventory and shipping and processing fees, right? In a service company, I'll just have QuickBooks subscription fees and then my processing fees if I allow you to pay with credit card. That's another thing with looking at your expenses. If you see where your processing fees are getting too high, stop accepting credit cards, especially while you're online, right? If you're someone's paying off online and you're a service-based business, you can say, send me an ACH transfer, send me a paper check, any of that things. You can, and then you can even have a limit. Like I have a limit, certain expenses or certain invoices that are over this threshold, I turn off credit cards because I'm going to get taxed with those processing fees. Yes, I can just charge the client the processing fees, but more than likely the client doesn't even want to pay the processing fees. So I just turn off credit cards and you can only pay me by ACH or check. Retail, you don't have that much flexibility because it's the volume, right? The volume is just so much. So you're probably always going to have some type of processing fee. So this is basically saying 60% of my revenue are costs. That's high. That's high. So this is another way to say this is for every dollar I make, 60% goes 60 cents goes to cost, meaning only 40 cents goes to profit. So that is why that's where you get into the issue of, oh, I just made $1. No, you just made 40 cents. Or, oh, I just made $1. No, you just spent 60 cents. So you can say it either way. So that is why this ratio is good to know, because as a business owner, you start getting all those notifications. Oh, I'm making money. This will help you say, okay, I made $10,000 today, which means I really made $4,000. It really helps you put it into, make sense in your head, the amount of money that you're actually bringing into your company. Yes, you're going to see the $10,000 in your account, but you know what? You're going to see that $60,000 go out. That $6,000 go out. And here's the thing about COGS. And this is why it could potentially bankrupt your company. This is another reason. COGS, usually you pay this before you even get the money. So in this particular example, you have to pay out the $6,000 before you even get the $10,000. Because how can you sell something if you don't have the inventory? How can I make it if you're in a manufacturing firm? How can I make it and ship it to you if I didn't buy the equipment? If I don't buy the materials, if I don't pay for the labor, if I don't have someone in here making it, how can I get it to you for you to then pay me? So that is another reason why you need to know this, because it helps you understand how much cash flow do I need to keep in my business at all times. And you need to keep enough cash flow that's going to cover your costs in order for you to make revenue. In a subscription-based business is not as difficult. One, because a service-based business. In a service-based business, it's not as difficult simply because with most accounting firms or most graphic design, they will either make you pay the invoice first before they do any work, or they make you pay a deposit. Right? If you're getting a new website redeveloped and it's like $5,000, they may say, we won't start until you give us at least $2,500. So a service-based business gets some of their COGS up front. They either get a portion of their COGS up front or they get all of their COGS up front, right? A manufacturing company or a retail company, you normally have to cover your COGS and your OPEX, well, at least your COGS, before you even make the money. So that's why it can potentially cause you to go bankrupt. Okay, are we good? Any questions before we move on? Yes. So in that particular example, Yolanda, that's what the ratio was telling us. For every dollar you bring in, you only make 40 cents because 60 cents are cost. So if you do your calculation for your own business, if this was 35 cents or if this was 90 cents, which would be, then that is basically what it's telling you. That's correct. Okay, so now we're going to talk about how can we reduce some of these costs, because you're probably like, listen, girl, you don't tell me that this can make me bankrupt. So what I'm supposed to do to make sure I don't go bankrupt. So these are some of the things that you can do. And I kind of try to hit over all the different type of industries. So embrace technology. This is really good for service-based industries. Again, Zoom. Before COVID, I was on Zoom, but I was not on Zoom as heavily as I am now. Now I'm like a Zoom expert, right? So embracing technology will help reduce your costs. So how does paying for Zoom help me reduce costs? So accounting, like I said, has been around forever. The practices of accounting are very old. So you still have some people who literally mail out brochures saying, hey, I'm an accountant. Hey, come let me do your taxes. Hey, let me do your bookkeeping. You may see that a lot during tax time. You go check your mail and you got all of these different people telling you, let me do your taxes from H&R Block, from TurboTax. They mail that out to you. That is costly. Now, instead of mailing out all of these things to tell you, hey, let me do your taxes, I could do a free webinar with Zoom and say, hey, tell you about, here is all the new different tax changes for 2020, which we had a lot. Come join this free webinar and I'm going to tell you about the different tax changes. At the end of the webinar, I'm going to say, hey, let me do your taxes, right? So I just paid that one fee for Zoom compared to all of the fees I could have paid for having to mail out stuff, right? So that's what embracing technology can help you do. Also, outsourcing. This is really big for service-based businesses as well. I don't do my graphics. I'm a numbers person. If you're trying, I can barely even draw a square, right? My heart is always lopsided. So I'm going to always outsource graphics. I'm going to also outsource ads, that sort of thing. You may say, again, how is that saving me money? And this may be one of those things where it's a non-cash type of savings of money. For instance, if it takes me an hour to make one graphic for IG, I could have spent that hour doing bookkeeping, taxes, tax plans where I'm actually getting money. So me using that hour actually helps me, it actually loses my business money. As in I can just outsource it. She could probably do 10 posts in an hour and I'm over here just generating more and more income, right? So that's what outsourcing can do. Also outsourcing in manufacturing. If you have this, if you're making this chair and this chair is just like a unique type of chair and you need this particular type of bolt. I used to work at GE and so we did this a lot. Certain types of our parts had a very specialized custom made type of screw. Instead of us wasting our time trying to make this custom screw, we would outsource it. We would provide them like the plans of how it should look, the dimensions, all of that. But we will have them then generate and make the screw and then send it to us. And we'll use that screw in our production, in a sped production of. So now we can, because again, with manufacturing, most of the time you don't get paid until people get their product. So the faster your production, the quicker you can get paid. So that's another way to do outsourcing can help you. Another way is, this is huge for retail people. Negotiate contract pricing. And this is also huge for if you are a hairstylist or a barber. This is really good for you as well because you have to buy what is called supplies. If you're in construction or you're a contractor, this can also be good for you too. So negotiating contract prices, this is twofold. This is something that we call price covenants. So you may hear that. And what this is, you're able to lock in your price based off a particular type of production, right? Most of the time when contract pricing, you have to either have developed a relationship with the person or you're going to promise them, right? In your negotiations, you're going to be like, well, I spend $100,000 a year. Let me give it to you. But if I'm going to give it to you, I don't ever want my price to change, for at least for this year, right? Price covenants or contract prices don't necessarily stay the same forever. They stay the same for a period of time. But this is where something that is variable can potentially turn into a fixed expense, right? So for instance, with inventory, you can negotiate with your vendors. Hey, I sell t-shirts. Let me always get my t-shirts for $5 a shirt, right? If they say, okay, I can get them for $5 a shirt, you can then say, I'm going to buy 100 shirts a month. That means your t-shirts is going to be $500 every single month. Now that variable price that was going up and down every single month because you were basically buying t-shirts when you needed them, now you know I'm going to spend $500 per month on t-shirts. That particular changes your variable cost into a fixed cost. But even though it's a fixed cost, it's still above the line. You still need to put it in your COGS to calculate gross profit. But that is a way to reduce it so it's not so much variability in it. Also, we talked about this, identify inefficiencies. So you know you're doing something that doesn't necessarily work and it's costing you a bunch of money, stop doing it. If you're paying for something that is not giving you the results that you expect or you need, stop paying for it. I know when I was first starting, I had MailChimp, Constant Contact, and MailerLite. And those are different email marketing type of programs. And I was trying to figure out which one I liked. So of course they got you in, try it for 7 days, do a 14-day trial, do a 30-day trial. And you know what happened? I forgot about them. So one particular month I was looking through my expenses and I was paying for 3 different email marketing platforms. I was using one. So figure out the things that you're not using. So the last 2 bullets kind of go together. Figure out what you're not using. Figure out what you're paying for that's not really making you money. Stop doing those things. Stop paying for those services. Okay. All right. So now we're going to talk about how do you use operating expenses to make business decisions. So the first one is huge, budgetary and spending planning. When you're trying to figure out cash flow, when you're trying to figure out, okay, can I make the bill payments this month? Do I need to raise prices? Do I need to lower prices? Do I need to find a new vendor? This using your OPEX will help you figure out what you are able to spend, what you're currently paying for, what can you afford. This is really good, again, raises and bonuses. But before you even have the employees though, the budgeting and the spending planning, it can tell you if you're ready to have employees. That's another, a really big question we get. Well, when is it the best time for my business to hire someone? When you look at your OPEX and figure out what you're spending, and then you look at your revenue and figure out what you're bringing in. And then what you want to do is do that OPEX ratio calculation that we talked about on the 2 slides above, right? You want to, so, okay, let me go to that slide while I talk to this. So you want to go through and add, for instance, you may say, okay, I want an assistant, I'm going to pay her $40K a month. You want to then put her in below the line, right? And say, I'm going to pay her not $40K a month, $40K a year. I'm sorry. You're going to pay her I want to be that assistant for $40K a month. Yeah, I'll get you coffee.
I'll sign up. Where do I go?
Right. You want some cream? What do you want?
I'm here for that.
Right. For $40K a year. I'm sorry. So you're going to then put that into your OPEX calculation. And then you're going to see how does this number change? And can you sustain it? So for instance, if you add in the salary and it changes your OER from 60 to 0.60 to 0.90, you're probably like, I can't hire somebody right now. Or I need to lower my expenses before I hire somebody. On the contrary, if you have an OER of 35 and then you put in the new salary and now your OER is 50, you can probably sustain also for that, right? You can still take a look and say, let me lower some expenses so I can hire someone and keep it at 35. You can definitely do that. But it's a way for you to see how hiring somebody is going to affect your income. Your cash flow. Also with raises and bonuses, before you may, again, with the assistant, he or she may save your life countless of times. Like if it wasn't for her, I wouldn't be on time. I wouldn't know what's going on. So it's time to give a raise and you like, I just want to pay her everything. But can you though? Can you? So again, you want to go back and do the OER calculation to make sure you're able to give the raise that you're telling them you're going to give them. Because everybody loves getting raises, but we hate when we get a raise, but then that check bounce because you can't pay us. So I just prefer you not to give me a raise than to have a bounce check, So definitely make sure you can afford it. Also with tax savings, having your OPEX in the right area, either below the line or below the line, can help you when you're doing taxes. When you're filling out your Schedule C, it's a difference of where you put expenses. Some people say, well, I just put everything on there. Yeah, but you probably shouldn't. And that, for instance, the PPP, it really showed you that putting items on the right line makes a difference in your business. So if you had folks that were heavily in retail and they just put COGS in supplies, they really overstated their profits and they got more of a loan, which was great for them. But if they ever get audited or whatever, that cannot turn out so great. So making sure you have your expenses categorized correctly so you can then do your taxes correctly. Okay.
Here we have a question in the chat.
What does OPEX? It means operating expenses. So it doesn't, it's not like an acronym, it's more of a shortened word. So OPEX is operating, so that's the O and the P is short for operating, and then expenses, the EX is short for expenses. And OER is operating expenses ratio. So I think, yep, we're done. So here's my contact information. Make sure you do a quick screenshot. Has my cell, my email, and my website. If you want to go on the website and either book a consultation, book a one-on-one, please feel free to do that.